Hello, everybody. Welcome to JAIIB CAIIB English Medium channel. I hope that everyone is doing fine. As you know that the exam is approaching for Indian economy and Indian financial system, we have only limited weeks left now. And when we talk about the most important topics, we must know by now. So today we are conducting module C plus D mini marathon. Likewise, we will be conducting the mini marathon for module A and B as well, and not only for IFS, for other subjects also, like we have the PPB subject, then AFM, RBWM. So stay tuned to this channel because in the last weeks of preparation, we will be maximizing our efforts for all of you, and we want you guys to replicate the same. Okay, so what is the agenda for this session? You will be given questions from module C and D of IFS, and what we expect from you, that you will reply, you will show the participation, so that we come to know that our students, whether they are ready for the examination or we have to work something extra. First question in front of you: which of the following statement with respect to the SHGs, the self-help group, is incorrect? So you have to tell me the incorrect statement regarding the SHGs. As you know that in the DFIs we have read various terms, terminologies relating to SIDB, how it evolved, and under SIDB and NABARD, we have good amount of loans refinanced for the SHGs. So what is the incorrect statement here with respect to SHGs? Lending to SHGs constitute part of priority sector lending of the banks. Financing to SHGs by banks are refinanced up to an extent of 90% by NABARD. Advances to SHGs are excluded as part of lending to the weaker sections, or loans to SHGs are provided collateral free. So we all know that SHGs are an integral part of the weaker sections category. They also form a part of the priority sector lending in the banks via weaker sections. As well as when I talk about the statement D, that loans are provided collateral free to the SHGs. That is also correct. But what about the refinancing or the financing to the SHGs, which has been refinanced by the NABARD, whether it is 90% or something else? So yes, this is incorrect statement. B is wrong because it is not 90%. It is beyond 90 as well. Okay. So do remember that there is no maximum cap when the NABARD refinances your SHG loans. Which among the following is are not salient features of the amendments made to Chapter 3B of the RBI Act in 1997 under the regulatory oversight of NBFCs? So we have NBFCs as the basic, you can say, financial institutions who are there for lending activities. And there are various features which have been amended from time to time in order to make some more regulatory framework for the NBFCs. And when we talk about the amendments which were done back in 1997 to the Chapter 3 of RBI Act, there were certain features to that. Which of the four statements do not form the feature list of that particular amendment? So making it mandatory for NBFCs to obtain COR, that is Certificate of Registration from RBI. Making it mandatory for NBFCs to maintain a minimum level of NOF, that is Net Owned Fund. Requiring all the NBFCs to create a reserve fund and to transfer a sum which is not less than 10% of their profits every year. So do remember this particular type of statement, because ultimately whenever we talk about the NBFC's oversight, the percentages are very important along with the NOF. Empowering RBI to file winding up petitions against NBFCs. So whether it was the amendment or not, uh, when we say that option A, B, and D, all the three were the amendments made for the regulatory oversight of NBFCs. The three, you can say, these are correct. C is wrong, requiring all the NBFCs to create a reserve fund and to transfer a sum which is not less than 10% of their profit. No, this cannot be managed because NBFCs already have funds crunch. The regulatory minimum NOF, that is net owned fund, for NBFC ICC, NBFC MFI, and NBFC factors, three types of NBFCs, shall be increased to dash as per the scale based regulation. So do remember, the SBRs are very, very important till 2027. Originally it was mentioned in the framework, but the recent amendments were there, and this particular framework has been amended. But yes, this particular limit was there as well, not amended. So the right answer will be, it should be increased to 10 crore. So 10 CR will be the right answer here. Here you can see that as on you can say March 2025, the amendment was that we will be going towards 10 crore by March 31, 2027. Right now, we have 5 CR as the NBFC ICC. We will move towards 10 crore by March 31st, 2027. Net, yes, this is the net on fund. Current net on fund is 2 CR. MFIs, again, we talk about by March 2027, you will have 10 CR, and factors also, it will be 10 CR. So do remember the last column. Right? This is highly important. Then we have LIC. The Life Insurance Corporation was established in which among the following phases of financial reforms in India? So we have various phases when we talk about the financial reforms. What was the phase under which we have established LIC? So it was phase two. Okay, phase two will be the right answer. Here you can see the various phases. Pre-independence phase one, prior to 1947. Phase two, post-independence 47 to 91. Post-liberalization 91 to 2010, and post-GFC, the global financial crisis, 2010 till present. Now let's have a statement-based question. These questions are favorite of IIBF, the multi-statement questions. Which among the following are the recommendations of PJ Nayak committee? So we have four statements in front of us to look into various problems related to bank boards, such as standards of specification, policy, legal, etc., and to suggest measures to be taken, whether this was the right approach, or for that matter the recommendation of PJ Nayak committee, that you should have various problems addressed to the related bank boards. To examine the working of bank boards, issue of strategy, growth, governance, and risk management in the banks. To review the RBI guidelines on government ownership in the bank. So yes, when we talk about the economic reforms, there was some guidelines issued by the RBI on the government ownership in banks. Whether it was suggested by PJ Nayak committee or not, that is the question. To analyze the work, conflict of interest, and independence in the bank board and make the suggestions towards the same. So what will be the right statement here? Correctly, it is the all of the above. 1, 2, 3, and 4 all are the right statements when we talk about the PJ Nayak committee recommendation, because this committee only solved the problem of various you can say domains, like we have the policy framework differently earlier, legal framework was different, and we do not have any kind of redressal mechanism which was addressed by this committee's recommendation only via the bank boards. Then we have to examine the working of these bank boards, along with that issue the strategy, growth, governance, and as well as the risk management in the banks, that was also ensured. RBI need to, RBI announced in fact after this particular committee's recommendation that we must have certain stakes apart from the government ownership in the banks. And obviously, to analyze the work, conflict of interest, independence in the bank boards, also make the suggestions towards the same. It was done by PJ Nayak committee, a very important committee for our examination. Next, we have the paid up capital for establishing the scheduled banks in India must be at least how much? So what will be the right answer here? Whenever we talk about the scheduled banks in our country, they must have a paid up capital. And what is the minimum paid up capital which should be there? Whether it is 5 lakh, 10 lakh, 5 CR, or 10 CR. The right answer will be 5 lakh. That is the minimum ask for the paid up capital. Which among the following statement is incorrect with respect to NABFID, that is National Bank for Financing Infrastructure and Development, NABFID. So as you know, this particular bank, so-called bank, is for financing the infra development projects in our country. So you have to select the most appropriate answer. The NAPFID has only developmental objects, whether it is the right statement or not, only the development objectives there. NAPFID does not take the deposits from the general public, whether it takes the deposits or not from the general public. The government initially holds 100% of the shares in the bank, which may subsequently be reduced to 26%. You have to tell me the incorrect, fine, incorrect statement. Do keep this particular word in your mind. The NAPFID was set up as a corporate body with an authorized share capital of rupees 1 lakh crore. So organization based questions, again, very, very important for the exam. NAPFID, when we talk about NAPFID, it is not only for the developmental objectives to, have some profit also. That was also the objective. So this is a wrong statement. Rest, we talk about the NAPFID, that yes, it does not take the deposit from the general public. Absolutely correct. The government initially holds 100% of the shares, and subsequently it will be reduced to 26%. That is also correct. The NAPFID was set up as a corporate body. Authorized share capital was indeed rupees 1 lakh crore. Which among the following is the provisions mentioned in the Section 25 of Banking Regulation Act 1949? So we have four statements in front of us. You have to tell me that which is the right option. So the provisions mentioned in Section 24. The Section 24 talks about what of the Banking Regulation Act, whether it is for CRR, SLR, MSF, or SDF. Mind it, all the four, they are somewhere down the line part of the RBI's monetary policy tools. So the correct answer will be Section 24 is dedicated for SLR, okay, in the Banking Regulation Act 1949. Anybody who can tell me that CRR is mentioned in which act, whether it is in the RBI Act or the Banking Regulation Act? Do let me know in the comment section. Which among the following was the first DFI, the Development Financial Institution, to be established in India? So whenever we talk about the DFIs, the chronology becomes automatically important, because the last time also in May 2025, we have seen the chronological order based question from the DFIs itself. The first you can say option is IFCI, Industrial Finance Corporation of India. NABFID, that is National Bank for Financing Infrastructure and Development. We have seen that this is somewhat a new bank. National Bank for Agriculture and Rural Development, the NABARD refinancing agency also. Then we have NHB, the National Housing Bank. The right answer for this question will be the first DFI in India was IFCI, Industrial Finance Corporation of India. Do remember this. Dash was the first DFI to be listed in New York Stock Exchange, the NYSE. So when we talk about the DFI which was enlisted in the NYSE, whether it was ICICI, IDBI, NABARD, or SFCs, the State Financial Corporation. Definitely, the first one was ICICI, Industrial Credit and Investment Corporation of India. Earlier, when it was established, it was not a bank. Okay, the banking functions somewhat were there, but full-fledged banking services were not provided by ICICI. Right now, we see this as a bank, only a full-fledged private sector bank, leading private sector bank, we can say. Which among the following microfinance institutions which are for profit? So you have to tell me which of the following are there for profit only. No developmental function is there. MFIs, which are the societies, the microfinance institutions having the features of the societies. Mutual benefit MFIs, NBFCs, MFIs, or all of the above. So yes, the correct answer will be the NBFCs, which are microfinancial institutions. NBFCs under MFIs will be the particular institutions which are working for profit maximization. So here you can see MFIs as per NABARD. MFIs are defined as those which provide thrift. Thrift is what? That you are trying to upscale something. Credit and other financial services and products of very small amounts, very, very small amounts. Fine. That is the basic meaning of microfinance. Okay. Mainly to poor in rural, semi-urban, urban areas for enabling them to raise their income level and improve the living standard. So always remember, microfinance institutions are there to provide funding of very small amounts and specifically to the poor section of society in rural areas, semi-urban and urban areas. And what is the reason why they provide these services to such segment of society? So that they can raise their income level. So why I am highlighting these things? Because mostly we have seen sometimes direct question has been asked from the MFIs that what is their role. Along with that, improve the living standards as well. A variety of MFIs that cater to the need of poor exist in India, and there are around 900 MFIs. Now, though they are more than 900, but initially it was 900 only, with the different legal forms according to which MFIs are categorized under three types. So, largely, when we say broadly speaking, there are three types of MFIs only in our country. First one, the not-for-profit MFIs, like we have the societies registered under the SRA, Societies Registration Act 1860. These are for not for profit. They also include trust set up under the Indian Trust Act 1882 and the not-for-profit companies established under Section 25 of the Companies Act 1956. Now, when we talk about the Companies Act 1956, it is also involved while defining the not-for-profit MFIs. Mutual benefit MFIs, these include state and national cooperatives, mutually aided cooperative societies, set up under the Mutually Aided Cooperative Societies Act, which was enacted by the government of Andhra Pradesh. So some things you have to remember, you have to mug up because they are directly part of MFIs. And when you talk about the acts for which we have specific categorization of MFIs, they are very, very important. Then we have for the profit MFIs, simply you have to remember NBFC's MFIs category. It is here for making the profit. Okay. So MFIs are very important, you can say, organization or the institution from where regularly IIBF asks the questions. Next, we have which among the following are the insurance depositors licensed presently by the IRDAI. So IRDAI has provided various licenses to your insurance depositories. Which of the following is the right answer? So whether NSDL Database Management Limited is the right answer, Central Insurance Repository Limited, SHCIL Projects Limited, Carvi Insurance Repository Limited. What is the right answer for the insurance depositories licensed by the IRDAI? So the right answer will be option D, that is all of the above. So do remember, all these four are the insurance depositories having a license from IRDAI. This question I think has been asked in the previous exam cycle, so you can make a note out of it. Which among the following are the features of e-insurance account? What is e-insurance account? You must know. Only then you will be able to mention the exact features. Each e-insurance account has a unique account number. Each account holder is granted a login ID and password to access their e-policies. Whether you have a unique account number as there is in the banks, insurance account is offered free of cost to the applicants. No service charges are there. An individual who does not have insurance policy cannot open an insurance account. So what is the right answer? The correct answer will be option A, that is 1 and 2 only. Even if you do not have insurance policy, you still can open the e-insurance account. That is why third statement is wrong. 1 and 2 will be the right answer. Then NARCL, a very important company. The concept of bad bank in India is to have National Asset Reconstruction Company coupled with the debt resolution company. That is what? Okay. So be very careful while answering such question. We are talking about the concept of bad bank. So bad bank, how they are defined in our country? We have one asset reconstruction company, the National Asset Reconstruction Company Limited. We have to club this with one debt resolution company. What is the name of this debt resolution company? Whether it is IDRCL, the India Debt Resolution Co Limited, NABFID, NADRCL, that is the National Debt Resolution Company Limited, or for that matter, we have Asset Management Company of India Limited, AMC of India Limited. The right answer, NARCL, plus we have the IDRCL, that is India Debt Resolution Co Limited. A very important question, a very important piece of information. From here, we can expect a question this time. Then it is expected that the sale of bad loans to the National Asset Reconstruction Company will be against how many cash percentage and balance dash being in the form of security receipts. Right. So what will be the correct answer here when we talk about the sale of the bad loans to the NARCL? How much percentage will be provided in the cash, and the balance amount apart from the cash will be in the form of security receipts or SRs. So again, the right answer will be option A only. 15% in cash, 85% the remaining amount in the SRs or security receipts. Section 17 of RBI is related to which of the following? So section 17 directly talks about what? So it talks about your business permitted to be conducted by the RBI. So all those businesses which are permitted can be conducted by the RBI. They are mentioned under the section 17 of RBI Act. After that, we have one question related to the provisions, very important part, provisioning norms. Provisions related to CRR, that is cash reserve ratio, are mentioned in which among the following sections of your RBI Act? So do remember in the overall setup also, whenever you are studying the chapter where we have the BRA, Banking Regulation Act, and also we have the RBI Act. These are very, very important. Fine. Do not just try to, remember or memorize the important ones. Also try to highlight the not so important sections as well, because ultimately what will happen, IIBF will ask you from anything. They can ask you from anything, anywhere. So the right answer will be what? Which section for provisions? It is section 42, the CRR. Which among the following statements are correct with respect to non-banking financial company, the NBFC deposit taking? So we have various types of NBFCs which we have seen, MFIs, then we have deposit taking also. So what is the right answer? Which of the following is the correct statement? NBFCs are allowed to accept and renew the public deposits for a minimum period of 12 months, maximum period of 60 months. They cannot accept deposits repayable on demand. So repayable on demand, whether they can accept or not. NBFCs cannot offer gifts or incentives or any other additional benefit to the depositors. The deposits with NBFCs are insured. So what is the right answer? Whether they are insured or not? The right answer will be 1 and 2 only. The deposits are not insured. Otherwise, why they are NBFC? Okay. If they are insured only, then they are replicating the banking function only. Fine. So NBFCs, yes, they are allowed to accept and renew the public deposit. Minimum period of 12 months, maximum 5 years or 60 months. Also, they cannot accept the deposits repayable on demand. So demand deposit is not acceptable. Then we have NBFCs cannot offer gifts or incentive or any other additional benefit to the depositors, like we have in the banks, where we tend to provide them with certain additional points, reward points, like that. Some incentives are given to the customers, but here in NBFCs you cannot do such things. Okay, A is the right answer. Which among the following committee has been constituted to make recommendations with respect to microfinance institutions? So we have MFIs. Okay, under the MFIs you have various regulations which you need to remember. The first one being which committee has basically tried to regularize the MFIs in our country. So it was recommended by YH Malegam committee, a landmark committee, I would say, very, very important. If you have not studied the YH Malegam committee, highly recommended. After the session, go and flip through the pages of YH Malegam committee. Okay, Nachiket More committee was for the differentiated banks, and for the establishment of IRDAI was RN Malhotra committee. Then we have one question on Narsimham Committee. Which among the following is our recommendations of the Narsimham Committee 1, 1991? So we have two committees, 1991 and 1996-7. Both these are very, very important, especially the second one. But let's see for the first one what the question states. The statement one states that establishment of four-tier hierarchy for banking structure was the recommendation. A phased reduction in SLR, statutory liquidity ratio, was one of the recommendation. Phased achievement of 10% CAR, the capital adequacy ratio. So as you know that SLR right now it has the maximum limit of 40%, and for today you can remember that June 2025 the SLR has been 18%. So what is the right answer? The recommendations for your Narsimham committee? Yes, indeed, it is option A only. 1 and 2 will be the correct answer here. 1 and 2. The phase achievement of 10% CAR was not one of the recommendation of your Narsimham committee. Okay, so here you have the elaborate discussion of the Narsimham committee 1. Establishment of four-tier hierarchy for banking structure with 3 to 4 large banks, including SBI. So do remember that these types of recommendations have been made by Narsimham Committee 1. And right now what we are seeing the consolidation of banking, consolidation of the banking in our nation. So consolidation of various banks. We want to have two banks at least in the top 100 category overall in the globe. So all these things are what? They are to achieve the consolidation itself. So nonetheless, when you talk about the Nasimam committee, you must have the four-tier hierarchy for the banking structure. 3 to 4 large banks must be there at the top, and at the bottom, rural banks engaged in the agri activity. So that is the major consolidation process, which we see right now also happening, because we have consolidated the RRBs. Now we have one RRB in one state. Earlier there were multiple RRBs. The supervisory functions over bank and financial institutions to be assigned to quasi autonomous body sponsored by RBI. Quasi autonomous means some you can say decision will be made by the body independently, some will be regulated by the RBI. A phased reduction in SLR. Yes, we need to reduce SLR so that the liquidity is there with the banks. Phased achievement of 8% of your capital adequacy ratio. So always remember capital adequacy ratio, the target was 8%. Abolition of branch licensing policy. Then branch licensing should not be there. Even if you are opening a new branch, you should not need a license, right, from the RBI. Proper classification of assets and full disclosure of accounts of banks, financial institution. Yes, proper classification must be there of all those assets. Deregulation of interest rates. So earlier every bank was having the same rate of interest to be offered. No competitive rate of interest was there. So that need to be deregulated, and in order to imbibe the story of competitiveness in our economy, in our banking system, it was highly important. Setting up an ARF, asset reconstruction fund, to take over the portion of the stressed asset loan portfolio of the bank. Okay, NARCL, mostly you can see that from here only, from this recommendation only, it was established. NARCL. Okay, next question. As per section 4 of the RBI Act, what is the paid up capital of the bank? So paid up capital of the bank will be what? Whether it is 2 CR, 5 CR, 10 CR or 15 CR. Paid up capital will be your 5 CR as per section 4 of RBI Act. Okay, do remember according to the Act, what is the exact number that we have to mug up for our exam. As per section 13 of the RBI Act, meetings of central board shall be convened by the governor at least how many times in each year, whether it is 2 years, 4 years, 6 years, or 3 years. So again, the meeting must be convened by the central board after every 6 months minimum. After every 6 months, you can call the meeting earlier also, but the threshold which you should not breach, it is 6 months. The minimum loan size for equipment finance under SIDBI, Make in India Soft Loan Fund for MSMEs, known as SIDBI Smile, is what? Now, there is a table in the book also, and we have covered in our classes as well, that talks about the initiatives of SIDBI. And most importantly, these you can say initiatives, they can directly asked in the examination. So the full form can be asked what is the full form of SIDBI Smile? You must remember the full form of SIDBI as well as Smile. Then the minimum loan quantum which you can finance, like that. All these things you must remember. So for this question, minimum loan size for the equipment finance is option B, 10 lakh. That is the minimum amount which you can get financed. Here for your reference, I have added that table. SIDBI, Make in India Soft Loan Fund for MSMEs, that is SMILE. What is the loan amount here? Minimum loan size of rupees 10 lakh for the equipment finance. Minimum loan size for other will be 25 lakh. So always remember the bifurcations as well. Then loan tenure up to 10 years, 3-year moratorium is there, but that is included in this 10-year term. Then we have the Smile Equipment Finance. That is a different, you can say, a separate loan scheme from the Smile. That is Smile Equipment Finance SCF. The minimum loan amount stands at again 10 lakh, and the loan tenure is 72 months. 72 months means 6 years. Then we have loans under the partnership with OEM, that is original equipment manufacturer. Up to rupees 1 CR, you can have the loan amount, and the loan tenure can be up to 5 years. After that, we have the working capital cash credit limit. It depends upon the financial appraisal, and the loan tenure stands at as per the term and condition of this facility. So always remember the tables which are given in the book, they are highly important. Do not skip them. Then we have SIDBI, loan for purchase of equipment for enterprises development, that is speed. For speed, what you have to remember is up to 100% of the machinery cost subject to maximum 1 crore will be the loan amount for new to bank customers, and 2 crore for the existing customers. The loan tenure will be 2 years, which include 2 to 5 years, which includes 3 to 6 moratorium period as well. Apart from speed, two more are important schemes. Otherwise, if you have time and you want to, see every scheme, you can pause the video and see for yourself. But for now, if we want to discuss, we will be discussing these two as well. That is Tulip and Star. So top up loan for immediate purposes, again provided by SIDBI, 30% of the existing exposure of whatever loan you have, or 20% of your net sales in the enterprise, subject to maximum of 2 CR. So 2 crore will be the maximum loan amount. And again, the loan tenure is 5 years, which includes your 6 months moratorium. Then we have STAR, that is SIDBI Term Loan Assistance for rooftop solar PV plants. So for solar panels, you have a maximum limit of 2.5 CR, and the minimum loan amount is 10 lakh, up to 5 years, including 3 to 6 months moratorium. Again, I'm reiterating the fact the tables are very, very important. Next, we have the question based on the RBI's Direction 2022. As per the RBI Regulatory Framework for Microfinance Loans Directions 2022, a microfinance loan is defined as a collateral-free loan giving given to the household having annual household income up to what? What is the annual household income which you must have? Okay, so the particular microfinance loan for those entities, enterprises whose annual household income is up to dash will get the collateral free loan. So the right answer will be 3 lakh. It should be up to 3 lakh, not beyond that. Asset finance company in India is one whose income arises out of the principal business, and it is not less than dash of its total asset and total income. So asset finance company, it is defined, well defined in our country, based on the net profit as well as your total asset and total income. So the principal business from the asset refinancing only, it should be 60%, not less than 60% of its total asset and total income. To remember this limit as well. Next, we have the price discovery in the financial markets. It is affected by which among the following? So five options are there. And when you talk about the price discovery, how you will be stipulating a particular price level in the financial market, whether it depends upon the supply and demand, attitudes towards risk, volatility, the funds, available information, or market mechanism. Indeed, when you talk about this question, all the five are correct. Supply demand also measures your price discovery. It contributes towards the price discovery. Risk also, the risk appetite, volatility, available information regarding various products and market mechanisms as well. So the correct answer will be option D. Then we have which among the following statements is are correct with respect to the payment banks. So payment banks in India, they were a hit back in 2018-19 with the advent of Paytm payment bank. But right now, somewhere down the line, people are having more inhibitions about the payment banks after the penalty was levied on the Paytm payment bank. Okay, so they are not opening, yeah, their deposit accounts more as they were in the 2018 era. So first statement, you have to tell me the correct one, right? Payment banks can accept deposits of up to rupees 3 lakh per customer, whether this is right. The money received as deposits can be invested in government securities which are eligible for inclusion in SLR, the statutory liquidity ratio. They are permitted to issue the debit cards, although not the credit card. So credit cards can be issued or not. Payment banks cannot lend. So no lending activities can be done by the payments bank. So the correct answer for this particular question will be again option B, that is 2, 3, and 4. They can accept deposit up to 3 lakh, or what is the limit? Do let me know in the comment section what is the exact limit. But when we talk about the SLR option, or for that matter debit card, they can, but credit card they cannot, and also they cannot lend. That these are correct. As per the section dash of the Banking Regulation Act, gives RBI gives the license to the bank. So which section is mentioned in the Banking Regulation Act via which RBI provides the license to your banks? So the right answer will be option C, that is section 22. How much was the minimum deposit of banks that were nationalized in 1969? A very important question. It has been directly asked in May 2025 examination. So nationalization phase 1 occurred in 1969. What was the minimum deposit of the banks which were nationalized during that era? So it was 50 CR minimum deposit. Which among the following committees has recommended the establishment of universal banks? So whether it was Narsimham Committee 1, Narsimham Committee 2, the Hote Committee, or Sodhani Committee. So the establishment of universal banks was by the Narsimham Committee 2. Do not get confused between 1 and 2. The universal banks were specifically mentioned in your Narsimham Committee 2 only. Okay, the Hote and Sodhani were both formed in the context of India's financial sector reforms and capital account liberalization. So always remember the reforms for the financial sector in our country and the capital account liberalization was provided by the Hote and Sodhani committee. Which among the following do not fall under the provisions of Banking Regulation Act of 1949? So we have the scheduled commercial banks in the Banking Regulation Act, state cooperatives, we have the private banks also. What about state cooperative agriculture and rural development banks known as CARBs? So yes, the right answer will be D. They are not under the provision of your Banking Regulation Act. Okay, we have the CARBs here, but before that, you must know that primary agricultural credit society, these are for the village level and are not covered under the Banking Regulation Act, and same is applicable for the SCARBs as well. So PACs as well as SCARBs, these are two you can say societies which are not covered under the Banking Regulation Act. Which among the following is the correct sequence of establishment of DFIs? Direct question has been asked in the previous exam cycle. So you have to tell me the chronological order here. Whether IDBI came first, IFCI came first, EXIM or SIDBI. Which was the first one to come? So we have seen in the previous questions also, IFCI was the first one to come. So for third, we have one as the right answer, and if you can eliminate others, the right answer will be option B only. So first of all, IFCI came, then came IDBI, then after that we have the Exim Bank, and then the SIDBI. So the right answer will be what? 3, 1, 2, 4. Yes, B is the right answer. Which among the following DFIs is not a specialized financial institution? So we have four options in front of us. The specialized financial institution we have to eliminate and arrive at an answer which is not a specialized financial institution. So yes, the UTI is not a specialized financial institution. Exim, NABARD and TFCI, all the three perform a specialized function. Okay, so yes, specialized are these: Exim, TDICI, NABARD, and TFCI. Development banks also you must know: IFCI, IDBI, ICICI, SCICI. Then we have SIDBI and NABFID. Investment institutions are LIC and UTI. Okay, always remember only two investment institutions are there right now under the category of TFIs. Now let's move on to the next module, that is module D. Okay, now we will be solving the questions of module D, where we have the first question in front of us. Mr. Sharma invested rupees 1 lakh in a short-term bond fund. After 9 months, the market value of his investment grew at 1 lakh 8,000. Under the absolute return method, what is the absolute return on Mr. Sharma's investment? Simply stated, you have to calculate it using the mutual fund return formula. Okay, we have the investment corpus here. It was 1 lakh, and the value ultimately became 1 lakh 8,000. What is the time? Time was 9 months. So absolute return method you have to utilize and calculate the absolute return of Mr. Sharma's investment. Try to answer, because such questions are expected from module D. So module B and module D in IFS, they have the scope of numerical questions. Okay, formula based or numerical question, whatever you want to call them, there is a scope of asking questions regarding your numbers. So the right answer will be option A, 8%. Here you can see absolute return. We have a formula, specific formula, that is current market value, which was 1 lakh 8,000. Original investment, you have to subtract that from the current market value, that is 1 lakh, divided by the original investment. Again, it is 1 lakh, multiply by 100. So the right answer, after calculating this particular calculation, after doing the calculation here, you will get the correct answer as your 8%. Okay, here you will get the answer as 8%. What happens to the partly damaged products or the goods or the wreck of property that is settled on a total loss basis in an insurance claim? So you have the insurance claim, right? But there is certain amount of, you can say, goods or the property involved which are partly damaged, not total loss. This is referred to as salvage, and after the claim is paid in full, the salvage is what? What do we do with the salvage once the claim has been paid in full? It remains the property of the insured, is divided equally between the insured and the insurance company. It becomes the property of the insurance company, or for that matter, is typically disposed of by the insured to minimize their losses. So what will be the right answer here? The salvage, mostly we have seen it becomes the property of the insurance company. Why? Because it has been settled on total loss basis. So definitely it will be the property of your insurance company. So always remember, salvage, although it has a partly damaged good or a wreck of property, but it has been settled on the total loss basis. That is why it becomes the property of your insurance company. Is the right answer. Okay, what is the meaning of salvage? In case of claims under various types of insurance policies, partly damaged goods or the wreck of a car or any machinery, other property settled on total loss basis is known as salvage. After settling the claim for full amount, salvage becomes the property of the insurance company. Generally, the job of salvage disposal is entrusted by the insurance company to the surveyor who surveys the entire case, who carried out the loss assessment subject to observance of procedures for your salvage disposal. The amount realized through salvage disposal will be set off by the insurer against the losses paid by them. So always remember, salvage will be part of insurance company's property. Okay, it belongs to insurance company. Next, we have question based on NPS in the context of National Pension Scheme. Which of the following statements accurately describes the key difference between tier 1 and tier 2 accounts? So we have two types of accounts, tier 1 and tier 2. You have to tell me that what is the correct statement for the NPS. Both tier 1, 2 accounts are mandatory for all the subscribers. Funds in tier 1, tier 2 can be withdrawn by the subscriber whenever they wish, or is there any time limit? Tier 1 is a non-withdrawable retirement account with the withdrawal restriction. Tier 2 is a voluntary savings account with free withdrawal. Okay. Tier 2 accounts are opened and operated independently of Tier 1 accounts. Whether there is a correlation between these two accounts or not, correct answer will be option C. That whenever we talk about the key difference, it will be Tier 1 is non-withdrawable. You cannot withdraw it. But yes, Tier 2 accounts, they have the free withdrawal process. So always remember, the non-withdrawal retirement account is Tier 1, and the tier 2 is voluntary saving accounts with your pre-withdrawal process. Here you can see for yourself, NPS account has two sub accounts, tier 1 and tier 2. Tier 1 account is mandatory, and the subscriber has the option for tier 2 account, for subscribing the tier 2 account and opening it and operating it as well. Tier 1 account is non-withdrawable, and it is a retirement account which can be withdrawn only upon the meeting the existing conditions prescribed under your NPS. Tier 2 account, this is voluntary savings facility available as on the add-on to your tier 1 account. Holder subscribers will be free to withdraw their savings from this account whenever they wish. So this is very important for our examination, the key difference. The funds contributed by the subscribers are invested by PFRDA, which is the regulator for the pension sector in our country, registered pension fund managers as per the investment guidelines provided by the PFRDA. So always remember, the funds which are contributed by the subscribers, they are invested by PFRDA. Now let's see one scenario based question. Such questions again, they are expected in the examination, and IBF has asked such questions earlier as well. Consider a scenario where an Indian small and medium sized enterprise SME engaged in exporting the leather goods to multiple buyers in different European countries seeks to optimize its working capital. I hope that you are getting the point here. We are talking about the factoring and forfeiting process via a particular case where the Indian SME is engaged in exporting the leather goods. So exporter is the Indian SME, and buyer is your different European countries who seek to optimize its working capital and mitigate the risk associated with international receivables. Based on the characteristics of forfeiting and for factoring, which financial institution, which financial instrument would likely be more suitable choice for this SME, and why? So whether it should go with the factoring or forfeiting, if it is supplying the leather goods to European countries, what will be the right answer? So definitely, when you talk about this particular question, forfeiting or factoring, first you must know that what is the difference between factoring and forfeiting. And after that, you must also know that whether the long-term export is required in the forfeiting or factoring, which is the smaller process out of the two. Only then you will be able to arrive at the right answer, which is your option D. For the factoring will be more apt for this particular case because inclusion of services like collection and credit protection would be particularly beneficial for the SME dealing with diverse international buyers. You have some complexity in the foreign land, so you must go with the factoring process, and also you are having multiple buyers. That is the another reason to pick the factoring here. Okay. So factoring, it is suitable for ongoing open account sales not backed by LCs or accepted bills of exchange. Forfeiting is suitable for one-off transaction which is backed by LC. Short term in nature is factoring, long term is your forfeiting. Long term means you can say that 1 to 5 years. Factoring can be with without recourse, okay, but the forfeiting is always without recourse. That is also one of the major reason why we pick the process of factoring over forfeiting, because we need to go with recourse in the international markets. The factoring requires continuous arrangement between factor and the client, whereby all the sales are routed through factor. All the sales will be routed by the factor only. In the forfeiting, the seller, that is the Indian SME, need not to route other business through the forfeiter. The deals are concluded transaction wise. So this was a favorable point for the Indian SME, but when we see the with the recourse, it is a better option to choose. Okay, so what is the right answer? D was the right answer. Next, we have a question based on the regulatory oversight by RBI and the different participation rules for various entities in call or notice money market. Which of the following scenarios is most likely to occur within this particular market? So we have different regulatory oversight defined by the RBI, and in this particular case, you have to tell me whether for the call or notice market, the options which are written here, they are correct or not. So first option is regarding the newly established RRB. Then we have a primary dealer, the scheduled commercial banks excluding RRBs, and select a mutual fund. Take your time and try to answer this question. Yes, so the right answer will be option C, scheduled commercial bank, which excludes the RRBs. Lending call money on an uncollateralized basis to another SCB experiencing a temporary mismatch in the CRR. That is where we have to, manage the ultimate, you can say, call or notice money market. That is where RBI's role is quite crucial. So whenever we have some mismatch in the CRR, then definitely RBI will provide the guidelines under the call or notice money market. When we talk about the banks, they often use the call money market for short-term adjustment to their liquidity, including the CRR maintenance. The lending is typically uncollateralized. Okay, no collateral is involved. Then one question based on tri-party agent. The applicant to become a tri-party agent should have minimum paid up capital, equity share capital of how much? So tri-party agent, you can become with the minimum paid up equity share capital of rupees 25 CR. Always remember this is very, very important for the TPAs. Okay, 25 CR will be the right answer. You should have past experience of at least 5 years in the financial sector as well. Then we have a question where you have to tell me the incorrect statement regarding term money market. So TMM, which of the following is incorrect? So whether it is collateralized basis or uncollateralized basis, and what is the time period? If you know these two things, you will be able to solve this question very easily. So the incorrect answer will be term money refers to borrowing or lending of funds for a period of exceeding 14 days and up to 1 year on uncollateralized basis. That is that is the correct answer. Okay, when you talk about option A, this is the apt explanation for your TMM. Yes, this is the right answer. The call notice term money market is a market for trading very short term liquid financial assets. And when you talk about the time period of lending, maybe a period of 1 day, which is known as call money. And when we talk about the term money, it is for exceeding 14 days up to 1 year. So A is the correct answer. 14 days and up to 1 year on uncollateralized basis. The institution which has surplus fund may lend them on uncollateralized basis to an institution with the short funds, the term money. Yes. So TMM was there, na? So for a time period exceeding 14 days and up to 1 year, that is for the uncollateralized basis. This particular question, I think we have to rephrase because here it is mentioned incorrect. Okay. You need to tell me the correct statement. Yes. So the correct answer will be option A. Fine. Next question we have in front of us. It is again based on the import factor's role in the international factoring. It is typically contingent upon a specific event related to the buyer's payment. Which factoring system triggers the import factor's involvement only upon buyer default? So whenever the buyer defaults, we have a particular system which triggers in. Which of the following is that? So the right answer will be single factor system. Okay, double direct import, triple factor. No, that is not correct. We only trigger the single factor system. In this type of factoring, that is the single factor system, import factor comes into focus only if the buyer defaults in making the payment. Okay. Buyer has defaulted, then you will have the import factor in the focus. That particular entity will be financing the entire project in the single factor system. Here also you can see the export factor and the supplier, they are directly connected. Supplier to the buyer, we have the delivery of goods. Factoring agreement is between the export factor and the supplier. Then we have the delivery of goods. After that, again, the assignment has been done from the supplier to the exporter. Then export factor will go for the funding and the buyer will provide the payment for the export factor. Then the import factor will also chip in with the payment if the buyer defaults on the payment. Okay, import factor will come only when the buyer defaults on the payment. The NAV of equity mutual funds index or debt mutual funds are required to be rounded off to how many decimal places respectively. So when we talk about the NAV of equity mutual funds and the index or the debt mutual funds, what should be the round figure? The decimal places 4 for the equity mutual and 2 for the index or debt mutual. Okay, that is the right answer. D is correct. Next, we have one question based on again sum of your formula. Miss Priya owns a boutique that she established 2 years ago with initial investment 20 lakh. So write it down. Investment initial was 20 lakh. She purchased a standard fire insurance policy with a sum insured. Sum insured is how much? It is 15 lakh. Recently, a fire damaged her boutique, resulting in the actual loss. What is the loss here? Loss is rupees 18 lakh. According to the principle of indemnity, you have to calculate the maximum amount of compensation. So whether it will be 18 lakh, the entire loss will be covered, 20 lakh, the investment will be covered, or for that matter, the sum insured will be provided, that is 15 lakh. So the right answer will be yes, none of the above. That is a tricky question. Deliberately, I have made the three options like this because mostly we have seen that students do not go for the none of the above option. In fact, the correct answer will be 13.50 lakh because of this formula. You have the sum insured divided by the value of the insured asset multiplied by the actual loss. That is the formula. And once you substitute the sum insured as 15, the value of your asset as 20 lakh and the actual loss which happened for 18 lakh, you will arrive at the answer for the maximum compensation 13.50 lakh, which is under the principle of indemnity, which states that the insurance company will make the good for your losses. Which type of REIT, real estate investment trust, is specifically required to invest a minimum of 24% of its asset in commercial properties like shopping malls. So we have different categories for the investment trust. Real estate investment trust, where you have to specifically invest minimum 24% of the asset in commercial properties. What is the type? It is your retail REIT. Okay, at least 24% for the retail REIT in the retail store. Office REITs operate in the office space. For mortgage REITs, estimated 10%. Then we have insurance ombudsman. They cannot take up the case. Which of the following case they cannot take up? The complainant has made a representation to the concerned insurance company and insurance has accepted. Whether the insurance has accepted, the insurer, or you can say the insurance company has accepted the claim or the complaint. Now, whether you can go for the insurance ombudsman or not, the claim has not been yet settled, or for that matter, no judgment has been provided. The complaint is made later than 1 year after the insurer had replied, the same complaint is pending in a court. The right answer will be option D. All these are the cases where you cannot approach the insurance ombudsman because the judgment is not out yet. Nobody has replied to yet. It is pending. Either it is pending in the court, or for that matter, you have uh, the time period lapsed in front of you. More than 1 year, no complaint will be entertained even in the insurance ombudsman. When we talk about the complainant has approached the concerned insurance company and it has accepted the offer, but they have not made any judgment. Again, it is not possible to go to the insurance ombudsman. So when you talk about the award compensation, it should not exceed rupees 30 lakhs in the case of insurance ombudsman. And when you talk about the representation, it should not be pending in other courts. Then we have real estate investment trust. Select the correct statement. Investing in real estate investment trust is capital intensive as compared to the direct investment in properties. Currently, there are only few REITs in India. REITs are regulated by SEBI and hence the chance of fraud are low. What is the right answer? Quickly tell me. The correct answer will be option B, 2 and 3 only. Okay, these are the correct statements. Because capital intensive, no, they are not capital intensive. It is the other way around. Okay. So when we talk about investing in REIT, it is not capital intensive as compared to the direct investment. The investors in REITs have a tax rate of dash for the interest income to NR unit holder, the non-residential unit holders. So always remember the particular tax rate stands at 5%. Next, again, REIT, very important chapter, right? So which of the following statement regarding the regulations of for REITs appears to be or are actually correct? So sponsor to hold not less than 25% of the total units of investment trust for at least 3 years from the date of listing. So whether the percentage of total unit is 25 or for that matter, the 3 years is correct. The special purpose vehicles to hold not less than 80% of assets directly in properties, not invest in other SPVs. Investment trusts to hold controlling interest and not less than 50% equity share capital or interest in the SPVs. Investment trusts to invest not less than 80% of the value in completed and your revenue generating projects. So the correct answer for this question will be again option D, that is all. So all these statements you must remember because ultimately when we talk about the REITs, these are the four most important statements. Then invitees, the infrastructure investment trusts. Here you have the first statement as it has two types of manager, investment and project manager. It has maximum 3 sponsors. The sponsors are mandatorily required to hold a minimum 10% stake in the trust for at least 3 years after the formation of your trust is there. Primary responsibility of the sponsor is to set up infrastructure investment trust and appoint a SEBI approved trustee. So the right answer will be option A, only two. This is the incorrect statement. Rest two are correct. Then for EPFO, you have to tell me which is the incorrect option here, incorrect statement. It was set up in 1952 and covers employees in specified economic sectors at firms with more than 20 employees. It is a statutory body under Ministry of Commerce or some other ministries there. EPFO administers the mandatory provident fund while outsourcing the management. The board is chaired by Ministry of Labor and Employment. The EPFO is apex decision-making body in case of the CBT or Central Board of Trustee. The right answer will be option C. That is only two. This is incorrect. Rest are the correct statements. Okay. Second is a wrong statement. Then for yuan number, universal account number, you have to tell which is the incorrect statement again. EPFO introduced the yuan, which acts as an umbrella for multiple member IDs allotted to the individual by different employers. Yuan is unique 15-digit number assigned to employees. It enables linking the three EPF accounts allotted to the single member, or for that matter, it was launched in October 2014 as a part of Pandit Deen Dayal Upadhyay Shram Jayate Karyakram. So the right answer will be option B only. That is 2 and 3 are incorrect. Okay, these two are incorrect. It's not 15 digit, right? What is the exact number of digit? Do let me know in the comment section. And it enables the linking of three EPF accounts allotted to a single member. Again, this is incorrect. Next, we have a question based on the type of lease. Which of the following describes the correct statement? Close and open-ended lease, upfront, back-end, percentage lease, and cross-border lease. What is the correct definition of different types of lease? So the correct definition will be your option C. That is all are correct. Close and open-ended. Close-ended, you will find that the asset gets transferred to the lessor at the end. And open-end, you have the option of purchasing the asset. The lessee has the option of purchasing that particular asset which it was using. Upfront back-end lease, again, upfront lease, higher the rental are charged and in the initial years and lower in the later year. Back-end lease, initial years, the lease rentals are less and they increase in the later years. For percentage lease, you will find that the lessor needs to pay fixed lease rental plus some percentage of your previous year's gross revenue. Cross-border lease, international lease also we know it like that. The lease and the lessor, leasee and the lessor are situated in two different countries. So all these are correct statement. Then you have a question based on the credit rating. What is the process of credit rating? How it goes? 9 steps are involved in the entire credit rating process. Quickly tell me the correct sequence. What is the first step out of these? Fine. So first step is entering into the agreement by the company, then appointment of the analytical team, obtaining information from the company. Then we have meeting of the company official, analysis of the company's financials, meeting of the rating committee. After that, we have communication of those ratings. Rating will be published and later on they will be monitored. So entering into the agreement will be the first one. Okay. So the correct answer will be option C. Then you have to tell me the incorrect statement with respect to the venture capital. Again, four options are there. The correct answer for this question, in the sense that which is the wrong statement. So the right answer will be three only. Only this statement is wrong. That is venture capital is termed as low risk, high return. No, venture capital is known as the high risk and high return capital. Definitely, it is for the long-term investment in a business which has the potential for the growth, and we have the probability of loss as quite high. And also, the investors which make the investment, they seek private equity stakes. So 1, 2, and 4 are correct. Third is the incorrect option or the false statement. Then we have the securities transaction tax. Which of the following is are the correct statement regarding the STT? STT is securities transaction tax or some other. It is levied by the particular stock exchanges. All the transactions that are done on the stock exchanges at rates prescribed by the central government from time to time. It came into effect from 1st October 2004. it in order to reduce the transaction cost in the capital markets, the STT was reduced to 0.1% on cash delivery transaction as on the budget 2015-16. So correct statement will be all except 4. So this is wrong. In the budget 2015-16, no, it was not there. But security transaction tax, it is levied on all the transaction done on the stock exchanges at the rate which is prescribed by the government of India, and it came into effect on 1st October 2004. Then we have ASPA facility, that is application supported by blocked amount in a rights issue. Which of the following conditions must be met by an applicant shareholder to be permitted to use the ASPA? So please tell me what is the right answer here. In the ASBA, you must be having the shareholder who is applying through the blocking of funds in the bank account with the SCSB, that is self-certified syndicate bank. And the list of these banks, it is published where, that also you must know, it is published under the website of SEBI. Okay. SEBI has been specifying the investors who can apply for the ASBA, and these are the conditions which you have to meet. Next, we have question on FIMDA, Fixed Income Money Market and Derivatives Association of India. What is the exact role? The key role is to function as principal interface with the regulators on issues impacting the functions of bond, money, and derivatives markets. Okay, SRO, as an SRO, it is working in our country. Then what will be the correct nomenclature for these central government security issued in March 2025? 15 years is the time period for which it has been issued. Coupon rate is mentioned as 6.5%. Again, this question has been asked in the previous exam cycle, so you must know the nomenclature also. So the correct nomenclature will be your 6.50 GOI 2040. You have to add 15 years in the 2025 and arrive at the maturity year. Next, credit ratings are broadly classified into three main categories that indicate the level of creditworthiness. Which of the following options correctly lists these three classified grades? So, what is the right answer? Again, high investment grade, and speculative grade. Do remember these three are very, very important. Okay, so the three CRAs in our country, CRISIL, we have the India ratings, then ICRA, CARE, Brickwork, Informex, and the Acute Rating and Research Limited. Which of the following is not stated as the objective of AMFI, Association of Mutual Funds in our country? So yes, when you talk about to promote the best business practices, yes, that is the function objective of AMFI. Then to act as direct regulatory authority, no, that is not correct. Interact with SEBI for the betterment of mutual fund industry, again, right? Promote nationwide investor awareness program, again, that is correct. B is the incorrect statement. Set up in 22nd August 1995. When was the riskometer for mutual fund product labeling modified to include the sixth risk level? So the correct answer for riskometer amendment was 2020. So here you can see in 2015 it started, in 2020 we have amended. Okay, so this was it for today's mini marathon. I hope that now you know for sure what are the most important topics in module C and D. If you have any kind of doubt, do let me know in the comment section. And for all of you, one piece of information that right now we are having maximum discounts on the JAB and CAB Mahapack. So for more details regarding the maximum discounts, you can contact us on 0981 981 9247, and the discount code which you can use is Y1003. All the best for your examination.